great. Thank you for joining us for this Financial Poise webinar. I am Candace Klein, a commercial law professor at the University of Toledo College of Law, and I am a bankruptcy and restructuring attorney at Saul Ewing. I look forward to being your moderator today. This episode is part one of a four-part webinar series called MBA Bootcamp. We open the MBA Bootcamp with today's episode, EBITDA and Other Scary Words. If you are looking at the cover of a PowerPoint deck that says something else, then you're at the wrong place. We are talking about EBITDA, financial ratios, and financial statements. So we will not go through the PowerPoint in order. We do these webinars as a conversation. And so you'll see that we will move around and we will also interact between the panelists. Feel free to take notes. On slide 7, we describe this particular webinar, EBITDA and Other Scary Words, and what our learning objectives are. If you look at slide 9, you will see a list of the episodes in this series, right? So EBITDA, balance sheets, cash flow modeling, and dealing with profits and working capital. Our panelists are listed on slide 6, and we have Steven Strasser, author of MBA in a Day and MBA in a Day 2.0. We have John Levitsky and Terry Orr of HKA, and they both bring tremendous forensic accounting and financial accounting and valuation experience. Again, I'm your moderator, Candace Klein, with the University of Toledo and Saul Ewing. We appreciate that you are not spending your time and money to hear infomercials. So if you want to get to know us better, we have included our bios at the end of the slide deck at slides 51 through 54. We have sponsors for this webinar. Sunburst Digital, the maker of Type to Learn, the #1 typing app for children K through 12. Max Asset, which includes online auctions and a turnkey solution. Sunburst and Max Asset are highlighted on slide 4. We also have a sponsor listed on slide 3, which is the National Law Review, a premier legal news website offering comprehensive legal news coverage. This webinar is a production of Financial Poise. More about Financial Poise is available on slides 2 and 59. If you do anything, subscribe now at financialpoise.com, and you may receive a free weekly newsletter. If you are attending the live premiere of this webinar, you can submit questions using your web portal. We may have an opportunity to address questions. If you are watching this webinar on demand and you have questions, see slide 49 for more information. Now, slide 5, this wouldn't be a legal-themed webinar without a disclaimer. So here we go. So you should not go out and act on what you hear or learn today. I am an attorney. You are not my client. We are not your lawyers. This webinar is produced for general education purposes, and the objective is to make you smarter and more comfortable communicating with your trusted professional advisors, and that the advice that we provide today is not personal to you. So thank you for your patience, and we will begin with our conversation around EBITDA and other scary words. We're going to start here on slides 11 and 12. They are a reminder that we're talking about financial and accounting ratios, and these are tools that are used by companies, they're used by investors to measure and understand and compare performance between entities, or say between operating divisions. So how good is company A doing relative to, for example, company B? They also remind us that we have to pay attention to our P's and Q's around financial inputs, right? You're only as good as the data that you put in. So part of this is a discussion about our financial statements, right? So these are our financial disclosures, and we talk a bit about them on slide 13. We have balance sheets, income statements, cash flow, and we'll talk about a few other related concepts. So if you have bad financial statements, you might very well have bad ratios, right? So again, financial integrity is an important concept. All right, let's go to the balance sheet. So John, I'm going to reach out to you to talk about this hypo. So we have a used and rare record store. They buy and sell old records. They pay rent. They don't have any employees. So what would the client's balance sheet look like for this small business, small operation? John.
Thank you, Candace. This sample here gives us some framework to answer the question. A company that buys and sells used music records, collectible music records, would have on its balance sheet, in essence, what it owns and what it owes. And the net difference would be its equity. So here we take a look at this sample balance sheet, and we also think about the nature of the business. So cash and accounts receivable and inventory and prepaid rent, if this record store does not own its premises, if it leases as a tenant, these would be the types of accounts we'd expect to see on the balance sheet. Long-term assets, if they are a tenant, we would not expect to see land or buildings, or if they have a building, perhaps if they have a small building, it might be here, or small improvements. So there are a few examples of line items here that we would not expect to see on a music record collectible small store. There may be furniture and fixtures or general equipment. And then on the other side, under liabilities, the liability section would be what's owed, accounts payable, taxes payable, perhaps interest payable if they have a loan. Salaries and wages payable would typically only be a liability if indeed the company had employees. Loans payable would also be what's owed. So the sum of the loan payable and the interest payable, the interest would be the amount due in the near term on the loan. And then the rest left over is a combination of accumulated historical earnings, which is the retained earnings, and then any paid in capital. There may have been an investment that the owner made, or the owners, if there's more than one owner, originally to fund the business, and that would be reflected in paid in capital. So total assets equals the sum of total liabilities and total owner's equity.
Oh, thank you, John. That's very helpful. And I just point our viewers to the sample balance sheet that's on slide 14. That's a very helpful explanation. So now we'll turn to Terry. And Terry, we're moving to slide 15. Could you tell us about another financial statement, this one being the income statement?
Happy to do so. Thanks, Candace. An income statement shows the revenues, cost of goods sold, then expenses incurred by an organization during a reporting period. This results in net income or earnings before taxes. Then taxes are deducted, resulting in net income or net earnings. The income statement reflects the activities of a company over a specific period of time, for example, a year, a quarter, or a month, while a balance sheet reflects the assets and liabilities that exist as of a specific date.
Great. Can you walk us through? We have a few categories here. So revenue, expenses, and then we get to net earnings. So what's net earnings?
Well, let me just walk through the whole statement again. The net income starts with revenues earned during the period reflected, in this case, a year. Revenues are reduced by direct costs of materials sold, in this case, the cost of rare books that are sold. This results in gross profits from sales. The next line items are indirect costs that will be incurred regardless of how many books are sold. For example, rent, salary, depreciation on capital expenditures, interest on debt, etc. This results in total expenses. then total expenses are deducted from gross profits resulting in earnings or losses before taxes. And then taxes are deducted and you're left with the net income or net earnings.
That's very helpful. And I just note that we do see earnings before tax. We will come back to that when we talk about EBITDA as a definition. So we will be looking at earnings before what? Interest, tax, depreciation,
Yeah.
and so on, amortization. All right, and that will be important in terms of our metrics. But Stephen, why don't we turn to you, because we have 2 down, 1 to go. There's yet another aspect to financial statement analysis, and that is the input of a cash flow statement. So can you talk about what is a cash flow statement and what would it look like?
Well, there's a saying that cash is the lifeblood of a company. And to rewind a little bit to our last two statements, we can think of the balance sheet as a kind of a snapshot of what the company looks like at a moment in time. Whereas the income statement is how the company has performed over a period of time. So think of balance sheet, snapshot, income statement is a movie. And even though we're very diligent on how we prepare these things, what a lot of outsiders want to know is, do you have enough money to pay your debts? How liquid are you? And a cash flow statement addresses the liquidity of an enterprise. So it's basically the ability to meet liquidity needs. There are different components of cash flow. There's income from the operation of the business, but there also might be cash flow in the form of either a loan proceed or a stock offering. Something like that will add to cash. So it's an important metric to see how much blood is in our animal, let's say. That are we going to be able to feed all of the organs well? And a banker is going to be pretty interested in this part of the company's profile. How well are they? How much liquidity do they have, and will they be able to service any additional debt, perhaps?
Yeah, I think that's really good. And, if you're running out of cash, then you're probably talking to someone like me with regard to bankruptcy and restructuring. So John, we've talked about a balance sheet, income statements, cash flow. Is there anything else that someone should look at to know their numbers for the business?
Thank you. Well, if we're looking at it from a historical financial information perspective, the typical categories are the financial statements and the income tax returns for a smaller business. And in both cases, they are reporting the historical financial information based upon the accounting conventions for the financial statements and the particular accounting requirements, which may be different for income tax purposes. So accounting really is an information system for management decisions. And within the information set that's here, the other of the 4 core financial statements we should mention is the statement of changes in equity. Just like the statement of cash flows reconciles in general all the activity over the course of a period from the starting cash balance to the ending cash balance, the statement of changes of equity also reconciles the changes in equity from year to year, from balance sheet to balance sheet, and identifies the changes in retained earnings or other capital accounts. For example, a company may have paid dividends or distributions. It may have added income or loss during the year. Those sorts of things are reflected in that statement. And then stepping back, a complete set of formal financial statements for generally accepted accounting purposes is considered to have all four of those: the income statement, balance sheet, statement of cash flows, and the statement of changes in equity. But it's also considered to generally have the notes in the back, management's discussion and explanation of the accounting basis, the basis of any estimates, and any other information management thinks is helpful to the intended user of the financial statements to understand them. And generally, before the core financial statements within a complete set, there's usually an introductory letter if they have an independent accountant or other preparer of the financial statements. Generally, there'll be an auditor's opinion if they're audited, or there'll be some other explanation as to whether it's a compilation or review. And if they did an examination, what they found from the examination. For example, if auditors are issuing a clean opinion, they will indicate that, and they'll indicate in general what work they did. But keep in mind, financial statements are the assertions of management. If there's an auditor, it's not the assertions of the auditor. Management is always responsible for the financial statement. So if you're saying, understand your numbers, if you're the sole proprietor of the business, these literally are in effect your numbers because you are responsible for preparing them. And if you have an employee or you've directed an outside firm to prepare them, you're still responsible for preparing them. I mentioned the income tax return. Quite often, there is additional information in the income tax return. Sometimes there's additional detail. Sometimes there are other things in reconciling items that are helpful to understand. And then the last thing I want to mention is that sometimes in a formal complete set of financial statements, there's an additional section in the back called supplementary information that provides more detail on certain categories. For example, Terry Orr mentioned cost of goods sold. There may be a lot of different elements in that calculation of cost of goods sold or in salaries and benefits, and supplementary information may break out additional detail on the components of those.
Yeah, so that sounds great, having a complete set of financial statements, and even better if they're audited. But in
Candace?
many small business scenarios, that's wishful thinking, and let's assume that the client has none of this and that they are keeping track of everything with their check register, basically their bank statements.
Hey, Candace, before
Yes.
we move further, I'd like to just comment on the financial statements we've covered. And in today's world, in the market today, the SEC on public companies is kind of the policeman of fair disclosures on financial statements. And the thing they've been most focused on recently, and where they've had the greatest judgments against companies besides their general disclosures, has been in the statement of cash flows. And so cash flow statement, while it's the lifeblood of the company, it shows that lifeblood. It breaks it out into three sections: cash flows from operations, and cash flows from financing, and cash flows from capital expenditures or capital transactions. And it's very important to the SEC that those cash flows are accurately reported between those three segments. And so that's gaining or getting a lot of attention today, the importance of where those cash flows are being reflected.
Yeah, I think that's a very important reminder that for publicly traded companies, these disclosures, they're regulated, right? And they're public, and they, are certainly subject to scrutiny. For small businesses, they don't tend to like that kind of scrutiny if they're closely held. So it might even be difficult to get the bank statements, but assume we do, and we have a little hypo here for you, Stephen. So we have our small business, they have $80,000 in cash in their business checking account. It's March 7th. A month before, they had 70,000. So doesn't that mean that they made $10,000 in a month? Isn't that right, Stephen?
Well, it means that they have $10,000 more in cash. But it brings up the fundamental, a couple of fundamentals. That is the notion of matching, where we want to try to match up expenses and revenue so that we're not providing a misguided look at the company. So sure, it's possible that there was $10,000 more in cash, but during this month, they may have contracted for $100,000 worth of inventory that becomes a payable. So that becomes, that's a liability to the company. So even though they have 10,000 more in cash, when you look at the overall picture of the company, they may not be in, in the kind of shape that you think about. So that brings up the approach that's a little more complicated, and that is using an accrual method of accounting. And for you attorneys practicing, I imagine you have among your clients several smaller businesses where their bookkeeping is basically their checking account. And whatever happens in the business is really reflected in a Schedule C, on their personal income taxes. So, doing a cash method is it sure is simple, but it doesn't very often give an accurate picture of the overall health of the company.
I think that's an interesting point that you raised. So you do have some simplicity, right? Life moves fast. It's hard to do all of this accounting. And maybe you do have an accountant engaged for the small business and you still do cash accounting. But what are the drawbacks to doing cash accounting versus accrual accounting? Anyone can respond.
Well, I'll jump in, Candace. Some of the drawbacks of it, besides the advantage of the simplicity, the drawbacks is it doesn't show your liabilities. You may think you have more available money to spend than you actually have because you don't see your liabilities. It also doesn't show amounts your customers owe you, and consequently, you may forget about unpaid customer debts. That would be one of the disadvantages, or a couple of the disadvantages.
So it makes it harder to manage accounts receivable?
Yes, accounts receivable, and it oftentimes it's not reflective of all your upcoming liabilities. So if you're not careful, you can spend that surplus cash and then not have it for liabilities that are coming due out into the future.
Yeah, you don't tend to account for the issues of timing as much.
Mhm.
And so being able to plan ahead, using an accrual method, you will be spreading out those expenses, let's say, to the periods where the company is benefiting from those expenses. So it's, it is simple, but it can be problematic.
And,
Yeah,
and
I was
Yes,
just going
John.
to say, building off what Stephen said,
Mhm.
cash is a kind of a short-term snapshot, and you look, and the accrual is the long-term picture. I think Stephen mentioned one's a picture and one's a movie.
Mhm.
But one's that kind of snapshot in time of how much cash you have at that point in time, whereas the other is a long-term perspective. And the impact is the effects that has on your decision-making and determining how or when to grow the business.
And accrual accounting gives the opportunity to segregate what are the profit-making activities at a particular point in time and identify where the profits have been earned and when, and distinguish that from the financing activities of the business, such as accounts payable, accounts receivable, loans, and then also whether there are any disbursements or investments from owners, as opposed to pure cash may just mesh all that together. And then what can go wrong if you're overly focused on just cash basis? I'll give you, for example, a real world example. A company where it takes a long time for it to collect on accounts receivable, but in real life, its level of activity is declining. And so on a cash basis, now that it has all these accumulated long-term receivables that it hasn't really recorded as receivables, but they're being collected on now, this company looks like it's generating a lot of cash flow. Well, it's generating cash flow from past sales activities. Current sales activities are in sharp decline. What's going to happen in perhaps a few periods? This company may go out of business because basically it's collected everything it can collect and it has no sales to generate new receivables going forward. The reverse can happen too. So the key concept of accrual accounting is to match revenues with expenses and be able to distinguish the profit-making activities of the company from how the company's operations are financed.
Well, let me jump in with a lawyerly look at this notion as well. So, we talked about this company that had a bump of 10,000 in cash. And my hypothetical was that, well, what if they bought $100,000 worth of inventory? Where an attorney may want to get involved here is in reviewing the contract to purchase that $100,000 in inventory. What are the terms of that contract for the inventory? What is there a personal guarantee on that purchase order or on that payable? What are the well, obviously, what are the payment terms? But there are really opportunities where legal analysis can also become involved in vetting some of these financial entries.
I think that's a good point, because as you incur additional obligations, you want to make sure also that there is an ability to meet those obligations. And if you have problems with budgeting and planning and, but understanding what is available coming off of operations versus what might have to come out of your pocket as an additional capital contribution, that might be important for a small business to know. All right. Why don't we proceed now to our defined term of the day, which is EBITDA, also the name of this webinar. So let's get into that. And we have a lot of slides that talk about EBITDA and flavors of EBITDA, right? So these are slides 29 through 36 in the slide deck. All right, Terry, why don't you tell us, well, what is EBITDA and how's it used? And are there variations on this theme?
Yes. So, Candace, I think you gave the definition earlier in the presentation, but EBITDA stands for earnings before interest, taxes, depreciation, and amortization. EBITDA provides an approximation of cash flows without factoring in expenses that are not part of core functions, such as interest and taxes, and before non-cash accounting decisions such as depreciation, amortization. So EBITDA is calculated by starting with a company's net income or the net profit or the bottom line or revenues less expenses, ever how you want to describe it. That's where you're starting. And then it's before or excluding, then deducting out the interest expense incurred for financing, and interest is considered a non-operating expense. So interest costs include any type of financing on bonds, loans, convertible debt, lines of credit, things of that nature. And then before or excluding taxes. And the reason you do that is because taxes vary from company to company and from jurisdiction to jurisdiction and by the structure of the organization. You could have a corporation, a partnership, an LLP, or a lot of different structures that have different taxing methodologies and rates. And then that is before you then exclude out depreciation. And depreciation is designed to capture economic decline in the value of tangible assets, such as property, plant, and equipment. There are various methods of depreciation under GAAP. Straight line, a double declining, just a variety of methods. Depreciation may vary from financial reporting and tax reporting. So you can have a depreciation model that or methodology for finance statements and a different methodology for taxes. And then depreciation is considered a non-cash expense because no cash outlay is associated with the asset's decline in value. Then you deduct or exclude amortization or before amortization. Amortization represents declining value of long-term intangible assets over its economic life and may include intangibles such as capitalized software, acquired intangible assets such as trade names, customer relationships, technology, etc. EBITDA became popularized in the 80s in leverage buyouts and determining how much debt the target company could service. And there's a lot of various variations. I think we have several of those, but there's a number of variations of EBITDA that are done based on specific things that are being focused upon. So I won't go through all those variations, but I think the primary deal is it's designed to be a approximation of cash flows from various types of, and then the modifications in EBITDA are cash flows from various industries and types of companies.
Yeah, so it's an attempt to try to grapple with all of this information and create a basis by which we can compare companies and maybe even value them. So John, and I'm direct us to slide 35. Why don't you tell us, well, how do we use it? Okay, we know how to calculate it, but how do we use it? What's it good for?
Well, since we talked about accounting information so far, one of the reasons that financial analysts who selected this and continue to use this is because it's based upon the accounting information that's generally available on most companies. The earnings, the interest, the taxes, the depreciation, and the amortization are generally line items in most companies' financial statements or some reasonably close variation of those. So the information is readily available. The calculation is rather straightforward to identify the components and calculate EBITDA. Terry mentioned public companies. Most public companies don't have audited EBITDA, but many public companies do disclose some custom non-audited calculations where they may disclose some special calculations of items like EBITDA. So the information is there. So Terry's mentioned a short-term proxy for cash flows. It's focusing on the earned portion of cash flows. And it is a proxy. It's shorthand form. We're going to talk a little later during this hour about valuation. It's not as precise as a forecast of cash flows and a discounted cash flow analysis, but it can be used for financial analysis comparability between peer companies, like my company versus some other for which I can get information. I can use it also to compare the historical performance of my subject company from period to period. And what you're trying to do is trying to isolate the readily available observable information among companies. For example, one of the objectives of accounting is to have some comparable basis for how the information is developed. Here you're trying to use a financial analysis tool based upon certain accounting components to do financial analysis. And companies are looked at multiples of EBITDA, perhaps for valuation. Terry's saying EBITDA gives you some kind of proxy as to debt coverage, availability. And then later we'll talk about how it may be used to apply a market approach with some valuation multiples. It's not necessarily the only valuation tool. But because of those items I mentioned, and today, especially in this third decade of the 21st century, financial data is readily available through both public and private sources to render these kinds of comparability analyses. Just have to keep in mind, like Candace was saying earlier, inputs and outputs, garbage in, garbage out. If you're trying to do a comparison, think through, is it a meaningful comparison? Just because the numbers stack up some certain way mathematically or comparatively, are you really comparing similar enough companies, and are you really comparing components that can be used as you're using them? For example, are there some normalization adjustments that may need to be taken? Because we're talking about using EBITDA calculated based upon historical information. There may be variations in certain costs or earnings of companies over the last 12 months that make that year perhaps not as representative as you are assuming. And the same thing going forward. A forecast of EBITDA sometimes is developed. Security analysts develop them sometimes for certain public companies. And for your subject company, there may be sufficient information to identify a forecast or a budget that can be converted into forecasts to look at, say, the next 12 months forecast of EBITDA as well and do the same sort of comparison.
Yeah, that's great. So let me just ask a follow-up question on something you talked about, which was valuation multiples. So what's the difference between, say, 4 times EBITDA and 8 times EBITDA when you're looking at valuation multiples?
Well, if we're using a market approach, if we obtain the multiple from comparison, say, with guideline companies or transactions in the industry, the 8 times versus 4 times. What does it suggest? A company with an 8 times multiple that, if that's truly applicable, suggests that each dollar of EBITDA that it's generated or is anticipate generating, whether you're looking historically or forward, the 8 times per dollar of EBITDA is worth more on an enterprise value basis. We're talking about the value of the whole company's, in essence, its operations before adjusting for surplus assets, like if it owned unrelated businesses or owned excess cash, and before subtracting debt. We're talking about the overall value of operations. But simply put, why could one company command a higher multiple like that, twice the other? It may be perceived as less risk. It may be perceived as having higher growth expectations. And if you wanted to see some key examples, especially over the last week, go look at sort of the Mag 7 publicly traded stocks, which include companies like Google and NVIDIA and the like, and you'll see some very high multiples. Why is that? They're expecting huge growth going forward. Now that during the last few days, there have been some variations. We're at February 28th, 2025. There's some variations in the market, but those companies are going to be perceived as much higher growth companies. And I would expect, I haven't done this, but if I would compare versus the multiples for some traditional industrial companies, that their multiples would be much lower. Why? Because they're probably perceived as having much lower growth. Now, on the other hand, the risk is a factor too. More risk generally suggests lower multiples.
Yeah, that's great. So this matters, and it's part of the language of finance when we talk about the value of certain businesses and structure in the economy, right? So high growth, high tech, maybe legacy manufacturing. We see different multiples. All right, so why don't we talk about disadvantages of EBITDA? And here, Stephen, I direct you to slide 36.
Yep. Well, I mean, the number we get from EBITDA doesn't reflect some variables that are going to affect, say, the long-term performance or viability of the company. And it's much like kind of the cash, the checkbook thing. It's more focused, a little bit more focused on today. And it's subject to, various bookkeeping entries can have a big effect on what the future of the company looks like. Choices of depreciation methods. What else? Different tax situations, let's say. So I mean, it's good in terms of trying to show the actual performance of a company, stripping away all of the kind of bookkeeping entries that we might be doing later. But it can be suspect when we rely on it and then in a year look back to what we made that assumption on, based on, and we find that the company has been, I don't want to say manipulating, but they have made choices that enhanced, let's say, their overall profitability. And I think we're going to get kind of into this sort of talks will get us to talking about GAAP and things like that.
Yeah, absolutely. So,
And Candace,
yeah, go ahead, John.
EBITDA doesn't get into what is driving the success of the company specifically, like their business model. So if you want a glaring example, we go back 25, 26 years ago. There were some very profitable mobile carrier cellular telephone companies, which a few years later didn't exist. Why? Because they were analog. Everybody was analog, but the industry was moving to full digital cellular connectivity. And there were a few really big players that weren't able to successfully make that transition. So if we looked at their EBITDA performance back in the late 90s, it may have looked great, but their realistic ability to continue that was at risk. And it was at risk either because they couldn't make the right deals, or they couldn't raise the appropriate financing, or they just couldn't get the right technology out in the marketplace at the time. So understanding enough about the business is usually very important to being able to appropriately use a metric like EBITDA.
Yeah, and I would add that an innovation pipeline and robust R&D activity is a driver. I mean, think about Kodak that we all grew up with, ubiquitous. And it's tough to find many of their products today.
So Candace, kind of building on both those comments, it hides, EBITDA might hide the fact that companies are choosing short-term high profits over long-term potential gains. And so it shows those high-term profits where they stick with an analog, or they stick with Kodak stuck with its, Polaroid type camera, when digital was coming along and they didn't want to invest the money and lose those high profits by trying to transition into another market. And so then when they fail to catch that technological change, then the drop off of their profits can be quite significant. So short term looks very profitable, long term haven't invested in the future.
Well, and not to get too deep in the weeds, but you also look at the incentives and the management compensation packages, whereas short-term profitability might be very important to, I don't want to talk about age, but a near retirement person, whereas those decisions, that person driving those decisions might be looking at the next 2 or 3 years versus looking 20 years. and foregoing maybe some of the more immediate rewards.
And then the other point I wanted to mention about understanding the subject company and the peers is that sometimes the traditional industrial manufacturing companies have very high EBITDA multiples. That alone doesn't mean they're expecting big growth or lower risk. It's possible they're in some situation where they're losing money for some reason, whether there's pricing pressure or whether they haven't made the latest round of new upgrades to their plant and made the capital investment to be more competitive. But their EBITDA may be very low and it looks like they're trading at a high multiple. But you'll want to get an understanding as to why that is. It's possible at that same time you might find that they're selling at less than book value. There may be certain situations where the market is looking at the earnings prospects of companies and the investors in general in the marketplace are thinking that a company's really only worth the liquidation value of its assets at certain particular times. And if they have a high asset base, it's possible they have a high multiple of EBITDA, but a relatively low multiple of the book value, the carrying value of their assets. So EBITDA can be useful, but you need to know more than that if you're going to intelligently apply it.
Okay, so we still really need to do some analytical legwork when we're trying to value a company. So I think we have time for a hypo, Terry. So why don't we dive into our lemonade stand hypo? Why don't you walk us through slides 37 through 40? What's going
Okay.
on?
Yeah, I'm happy to do so. And I think this kind of illustrates some of the weaknesses that we were talking about, some of the differences that why you have to dig deeper. So we have two lemonade stands that have identical operations. The only exception being that stand A is self-funded through equity and stand B primarily uses debt to fund its operations. Stand B's interest on the debt is $150. Therefore, looking at net income before taxes, stand A that used equity is $150 more profitable than stand B. So it's $650 compared to $500. The after-tax effect between the two stands is $52.50, or $150 difference at the 35% tax rate. So when you compare, when these two stands are compared based on EBITDA, those two stands are equal. Each produces $700 in EBITDA from $1,000 in sales. So I think what this hypo is trying to illustrate is, you have two companies that have the same EBITDA, but they operate quite differently, and it brings up, some of the weaknesses in just only looking at EBITDA as a comparative measure. You've got to dig a little deeper, but it does give you a quick thumbnail comparison. So it has its advantages, but if you're going to use EBITDA as in significant transactions, you have to dig a little deeper to fully understand the valuations, the market valuations, and the use of EBITDA in those companies.
Yeah,
And
that's
Candace,
really helpful. Great illustration. So, John, why don't we pivot to our variations on a theme? This is covered slides 41 through 44. So it's not just EBITDA, but we have a few other approaches that are possible too. Could you just briefly tell us what the differences are between these additional measures? And I just
yes.
highlight a few of them.
So the EBITDA parts of these variations mean the same things we've been talking about. So EBIT is closer to operating income from operations. In many cases, it's income from operations before tax. So the depreciation and amortization are not added back. If we have companies that are in a capital intensive industry or have similar rates of capital intensity, capital investment, EBITDA may be an alternative. In many situations, given the availability of information today that's so abundant, many analysts will run actually all of these calculations to the extent they're applicable and then compare. EBITDA is still the most popular, but a lot of times they'll compare with EBIT. And then why is there something called EBITDA? Because many companies don't own their primary factory, their primary tangible operating assets, don't own their facilities, they rent. And then we've been talking about one of the advantages of EBITDA is comparability. Well, not every company has the same amount of relative rent cost or rent expense or hasn't necessarily financed the facilities in the same way. So in many cases, EBITDA, trying to find additional ways to make the analysis even more comparable. The analyses may be run on an EBITDA basis. That's EBITDA before rent expense. We also should keep in mind that over the last 5 years, under US generally accepted accounting principles, the accounting on full accrual financial statements for major companies has evolved, that many companies now under GAAP do not only report rent expense, but they report the right of use asset and the present value of future rent expense on their audited financial statements. So there's additional information available that in today's world, there may be some further refinements considering that other information is available. Why is that now required under GAAP for many larger companies? That's because Terry mentioned the SEC. Private companies aren't directly regulated by the Securities and Exchange Commission, but the primary authority in the United States for generally accepted accounting principles comes from the SEC. So what they have been implementing for public companies in many instances has transformed into something that also applies to private companies. They're trying to get more transparency and more comparability between the financial information of companies. And then one other variation we have here is EBITDA RM. If a company has a property management company, for example, that's one of its affiliates or has a property management company that it outsources, this would be adding back those property management fees. And if I could just take a luxury of one other 90-second moment here, Candace, when Terry and you were talking about that prior example, for restructuring and turnaround attorneys like you, Candace, one of the key things is trying to identify where does a company have good business model, but has too much debt, has a currently poor financial position situation. Maybe it's through no fault of their own, or maybe they were overly aggressive. And so a lot of times in restructuring, what's one of the objectives is try to find a way to salvage the value of that good operating business, but somehow manage or restructure that debt through some turnaround process or sometimes through bankruptcy.
I think that's really good. Debt is, not often your friend. So, hence, the need for bankruptcy and restructuring professionals. I'm going to just highlight that we have some slides in the deck around enterprise valuation. They exist on slides 45 through 48. We've used some of that terminology in our conversation. We've talked about enterprise value. We've also talked about, for example, book value. We've just mentioned GAAP. So why don't we pivot to Stephen, and I will take us to slide 16. And why don't you tell us a little bit more about what GAAP accounting means?
Well, it's really developed out of the need to provide a consistent, well-defined language, terminology, methodology, so it's possible to be able to compare one company to another. As you can imagine, there's lots of ways to do books. And left on our own devices, we could be very creative. And GAAP sort of puts us in a lane, or gives us certain guidelines so that when we follow those, our numbers are more believable than if we just take out our checkbook and show somebody what our balance is.
So Candace, one of the things that you'll see this term gap used for attorneys is a lot of M&A transactions will say the financial statements have been prepared in accordance with generally accepted accounting principles, or GAAP. And in buying a business or selling a business, there's reps and warrants that it is, they have been prepared, the financial data that's been provided has been prepared in accordance with GAAP. And if it's found that there are exceptions to that GAAP preparations, then it allows the buyer or the seller, generally the buyer, to push back on the purchase price and make some adjustments in that.
Yeah, so that's good. And sometimes it varies by industry. So for example, in row crop agriculture, GAAP may not be the most useful way to do some basic accounting and reporting, and your loan agreement will accommodate that, right? But you're absolutely correct, Terry, that having an obligation to generate, not just financial statements that are consistent with GAAP, but also audited financial statements. That too may be required. And again, you're just trying to raise the bar in terms of reliability. Because there are a lot of incentives, or we'll say human frailties, when it comes to financial reporting. So Terry, why don't you give us here in the last couple minutes some more context around acquisitions and where we might see adjustments, and in particular, working capital adjustments. And we've used that term, working capital. Could you tell us what it is and what does it mean to make a working capital adjustment?
Sure. Well, working capital adjustments, I think are we focused on kind of the what slide? I just don't want to go off based on what slide
Yeah, so this is a conversation point. So it's just in the context of an acquisition.
Oh, okay. Okay. So working capital is your differential between typically ones that you'll have is your current ratio, the difference between your current assets and your current liabilities. And working capital then becomes the excess of your assets over your liabilities, the surplus that you have of assets over your liabilities.
So one of the points when you are making an acquisition, right, you don't really want to overpay. You're trying to mitigate some risk. There's a lot of negotiation points. That can also include things like earnouts, right? So, how good are these numbers and what are you able to leverage out of the company that you're acquiring? So we do have a couple slides where we see how these ratios are used by different players in the transaction, right? So I will just note that a lender's perspective is covered in slide 26, a founder's perspective, slide 25, investor perspectives, slide 20 to 24. So given this material, and we'll just end with some concluding comments, what's most important to know as a small business owner? So Steve, I'll start with you. In this topic of EBITDA and financial statements, what's your most important advice to a small business owner?
Well, it's pretty fundamental. Know your numbers. And I mean, I taught entrepreneurship for 20 years. And I will tell every one of my students, the other course you should be taking is an accounting course. Because if you don't know your numbers, you got a problem.
Yeah.
So I'm really understanding your operating model, being able to also be able to see where the potholes are going to be down the road, because especially in small businesses and especially in early stage businesses, running out of cash is pretty common.
Okay, Terry, John, any last words?
I was gonna say, just kind of building on that working capital and some of the things that we've talked about, besides knowing your numbers, is that oftentimes, what might appear to be good numbers, might be not as good news. So if you have excess working capital, it might mean that you have too much inventory, for example, or that you're not taking advantage of the debt, and you have the ability to add debt to the company. So it's not only knowing what your numbers are, but how to use your numbers to strategize how to build the company. And so I would say, know what your numbers are, but know what those numbers are telling you, and the significance of how those numbers play into your strategy to build or to sell or to position the company for some type of activity or transaction.
Okay, John, just a few seconds.
Just to add to what Terry and Steve are saying, in addition to knowing your numbers, in addition to comparing what Terry and Steve are saying, I just want to add on, what you can do as the owner or the manager. There are variables here that you can influence. There are variables here, the ones that you can't influence. You may be able to get ahead of them. So keep that in mind. There are actually some buttons that you can push if you understand your accounting information and how you stack up against others.
That's great. Well, thank you, Stephen, Terry, and John. We appreciate all of your good comments. Thank you, audience, for your time and patience, and we hope that you've enjoyed today's webinar, which is episode number 1 in Financial Poise's MBA Bootcamp series. We thank you for listening and have a great day. Thank you.
Bye-bye.
Thanks.
Bye-bye.
Bye.